The world is changing fast. Subscribe to Capital Explained to stay informed. Something important is unfolding right now, yet it is barely making headlines in the United States. The reason is simple. The implications are uncomfortable. They challenge assumptions that have defined the global financial system for generations. Across 3 continents, 5 major economies representing more than 2 billion people and roughly $15 trillion in economic output are reducing their exposure to United States Treasury bonds. Not slowly, not cautiously, but decisively. Over the last 18 months alone, these countries have sold more than $400 billion of American government debt. To put that in perspective, that amount exceeds the total annual economic output of Austria and is roughly double the GDP of Vietnam. The money leaving US treasuries is not sitting idle. It is being redirected into assets and systems that do not rely on American fiscal credibility or dollar dominance. For over 70 years, US treasury bonds have been considered the safest financial asset on earth. Central banks store them as reserves. Pension funds depend on them. Financial institutions use them as collateral. They are the foundation upon which global finance is built. So when multiple large nations reduce their holdings at the same time, they are sending a message. Whether intentional or not, they are signaling declining confidence in America's long-term debt management. They are questioning the permanence of the dollar's dominance, and they are preparing for a different financial future. What makes this moment remarkable is timing. This is not happening during a financial panic or recession. It is happening while markets remain near highs, unemployment is relatively low, and policymakers publicly claim stability. The selling appears deliberate rather than reactive. The 5 countries involved are China, Japan, Saudi Arabia, Brazil, and India, collectively among the largest foreign creditors to the United States. Together, they still hold close to $3 trillion in American debt, yet their direction has clearly shifted. Let's begin with China, the most strategic case. As of late 2025, China holds approximately $759 billion in US treasuries, making it the second largest foreign holder after Japan. But the trend matters more than the level. In 2013, China owned about $1.3 trillion in US debt. That means holdings have fallen by more than 40% over 12 years, and the pace of reduction has accelerated recently. In just the past 18 months, China has sold roughly $136 billion, more than during the previous 3 years combined. This does not look like portfolio adjustment. It looks like long-term repositioning. There are 3 major reasons behind China's actions. First, geopolitical risk. Relations between Washington and Beijing have deteriorated significantly since 2018 due to trade conflicts, technology restrictions, and military tensions. After the freezing of Russian central bank assets in 2022, China recognized a vulnerability. Large holdings of US bonds can become political leverage. Reducing exposure lowers that risk. Second, strategic de-dollarization. China has spent years building alternative financial structures, infrastructure financing programs, currency swap networks, and development of a digital yuan, all designed to reduce reliance on the dollar. Selling treasuries aligns perfectly with that objective. Third, domestic economic priorities. China faces slowing growth, real estate instability, and rising internal debt. Bringing capital home helps stabilize its own economy, but perhaps the clearest evidence of strategy lies in what China is buying: gold. China has dramatically increased its gold reserves over the last decade while simultaneously reducing treasury holdings. Gold acts as a hedge against currency risk. If a nation expects the dollar to weaken over time, shifting reserves from bonds to gold becomes logical. When the world's second largest economy steadily exits your debt market while building an alternative financial framework, other countries take notice. Now consider Japan. It's a completely different motivation, but the same result. Japan remains the largest foreign holder of US treasuries at around $1.2 trillion, yet its holdings have declined from previous peaks. Unlike China, Japan is a close ally of the United States. Its selling is not geopolitical, it is mathematical. For decades, Japanese interest rates were near zero. Investors seeking returns had little choice but to buy foreign bonds, including US treasuries yielding 2 or 3%. That dynamic changed when Japan began raising interest rates after nearly 30 years of ultra-low policy. Domestic government bonds suddenly offered meaningful yields, allowing investors to earn returns without currency risk. Naturally, capital began returning home. Japan sold over $119 billion of treasuries in a single quarter of 2025, one of the sharpest declines in years. Not because of conflict, but because domestic alternatives became attractive. Yet for the US debt market, the effect is identical. Demand falls, borrowing costs rise. Next comes Saudi Arabia, whose actions affect not only debt markets but also the monetary system itself. For decades, global oil trade operated primarily in dollars, creating constant international demand for US currency, the foundation of the so-called petrodollar system. Recently, Saudi Arabia has allowed oil transactions in multiple currencies. While the dollar remains dominant, exclusivity has disappeared. Some large energy deals now settle in yuan and other currencies. This matters because energy trade historically forced countries to hold dollars. If oil can be purchased without them, global demand for dollar reserves gradually weakens. Saudi Arabia has also reduced Treasury holdings while diversifying investments and partnerships across Asia. The shift reflects hedging rather than hostility, preparing for a multipolar world economy. Finally, Brazil and India represent emerging powers making pragmatic adjustments. Neither country is abandoning relations with the United States. Instead, both are diversifying reserves, increasing gold purchases, and participating in alternative financial arrangements such as regional payment systems and development banks. Their reductions in Treasury holdings are smaller individually but symbolically important. When allies diversify, it signals risk management rather than political conflict. Together, these actions reveal a broader pattern: preparation for a financial system where the dollar remains important but no longer exclusive. Why now? Because several pressures have converged. US national debt has reached historically high levels relative to economic output. Annual deficits remain large, and interest payments consume an increasing share of government spending. Foreign lenders naturally evaluate repayment sustainability. When debt grows consistently faster than income, confidence slowly erodes. At the same time, global trade is becoming more regionalized. Geopolitical tensions encourage financial independence, and technology enables alternative payment networks. No single event triggers change. Instead, gradual adjustments accumulate until they become visible. The key point is not that the dollar collapses tomorrow, or that treasuries suddenly become worthless. Rather, the global system may be evolving from singular dominance to shared influence. For decades, the world relied on one financial center of gravity. Increasingly, it appears to be distributing weight across several, and when the foundation of a system changes slowly, the consequences are rarely immediate, but they are often profound. Foreign lenders understand the direction of the risk, and many are reducing their exposure before any visible crisis actually appears. Another major factor is interest rates. In 2020, borrowing costs in the United States were close to zero. By 2023, they climbed above 5%, and even after easing slightly, they remain near 4.5%. Rising rates have a simple mathematical effect on bonds. Older bonds lose value. Imagine an investor who bought a treasury bond in 2020 paying 1%. Today, new bonds offer around 4.5%. No rational buyer would pay full price for the older bond, so its market value drops. Investors holding large quantities of older bonds face losses, and many prefer to sell now rather than risk deeper declines if rates rise again. A third pressure comes from the changing global currency order. For the first time since the Second World War, the dollar's dominance is being seriously questioned. New payment networks, regional trade agreements, gold accumulation, bilateral currency swaps, and digital currency experiments all point toward the same objective: reducing dependence on a single currency system. Holding dollar-denominated assets therefore appears less certain than it once did. Fourth, geopolitical tensions have intensified. Rivalry between major powers, sanctions policies, and regional conflicts make countries wary of keeping too much wealth inside another nation's financial system. The freezing of foreign reserves in recent years demonstrated that financial assets can become political tools. Governments now seek diversification to protect themselves from that possibility. Fifth, unpredictable trade policy has unsettled markets. Tariff threats, economic pressure tactics, and shifting alliances send a message that economic relationships may change quickly. Countries respond by reducing reliance rather than increasing it. Sixth, alternative investments look more appealing than before. Gold prices continue reaching record highs. Some Asian markets show faster growth prospects. European bonds offer moderate returns without currency exposure for European investors. When options exist with comparable yield but lower geopolitical or currency risk, investors naturally rebalance portfolios. None of these reasons alone would cause dramatic systematic selling. Together, they create powerful momentum. Countries are not coordinating in secret meetings to dump US debt simultaneously. Instead, they are independently interpreting the same signals and reaching similar conclusions. Risk has increased, diversification is rational, and exiting early is safer than exiting late. But selling is only the beginning. When several large holders sell bonds, prices fall. Falling prices push yields higher. Higher yields increase borrowing costs for the government issuing the debt. Higher borrowing costs expand the budget deficit. Larger deficits require issuing more bonds. More bonds increase supply, which pressures prices further downward. This creates a feedback loop. Suppose the same group of countries sells another $400 billion over the next year, and other nations follow cautiously. Total foreign selling could approach $800 billion. Foreign investors collectively hold roughly $8 trillion in US Treasuries. If just 10% leaves the market, the system must find buyers for that massive supply. Domestic institutions may absorb part of it, but they already hold enormous quantities. Their appetite is limited. The central bank could intervene by purchasing bonds, but that effectively creates new money, injecting hundreds of billions into the financial system, risks reviving inflation just as it has begun cooling. If neither domestic buyers nor central bank purchases fully offset the selling, yields must rise enough to attract new investors. The question becomes, how high? If rates move towards 6 or even 7%, the government's interest burden would surge dramatically. On tens of trillions of dollars in debt, interest payments could consume an enormous share of tax revenue. At that point, policymakers face extremely difficult choices: severe spending cuts, large-scale money creation, or restructuring obligations. None of those outcomes is painless. Financial cascades rarely stop once confidence shifts. Markets operate heavily on perception. When investors believe an asset is unquestionably safe, stability persists. When belief weakens, reversal becomes difficult. History provides many examples. Debt crises often appear sudden, yet warning signs emerge years beforehand. Rising borrowing costs, increasing debt loads, and foreign investors quietly exiting. Only after confidence breaks does the crisis become visible. The difference here is scale. Smaller countries experiencing debt crises affect their regions. A crisis involving the world's primary reserve asset would affect every economy simultaneously. The global financial system depends heavily on the assumption that US government bonds remain secure and liquid. If that perception weakens significantly, stabilizing forces become limited. From the perspective of foreign governments, reducing exposure early lowers vulnerability. However, collective reduction can itself accelerate instability. Fear of future risk prompts selling, and selling increases the very risk investors fear. Now consider what this means for individuals rather than governments. First, borrowing costs across the economy would rise. Mortgage rates, auto loans, credit cards, and business financing all reference Treasury yields. If government borrowing costs climb, private borrowing follows. A mortgage affordable today could become unreachable within a year, pricing many households out of home ownership. Second, inflation could return. If authorities respond to weak bond demand by creating money to purchase debt, the money supply expands. More currency chasing the same goods leads to higher prices. Everyday expenses, food, fuel, rent, increase faster than wages. Third, equity markets could struggle. Higher interest rates reduce corporate investment and increase recession risk. Lower growth expectations push stock valuations downward. Retirement accounts heavily invested in equities would lose value, potentially delaying retirement plans. Fourth, employment conditions would weaken. Companies facing higher financing costs and slower demand reduce hiring or cut jobs. Rising unemployment places pressure on households already coping with higher living expenses. Fifth, government programs would come under strain. When interest payments absorb large portions of revenue, less funding remains for infrastructure, healthcare support, and public services. Citizens feel the effects through reduced benefits or higher taxes. Finally, social tension increases during economic stress. Financial insecurity often fuels political polarization and erodes institutional trust. This pattern has repeated across many historical debt crises. Such outcomes are not guaranteed, but they illustrate why financial stability matters beyond markets and investors. Government debt influences daily life indirectly through borrowing costs, employment, and purchasing power. Bringing the situation together, multiple nations are gradually lowering reliance on US debt. Some reductions are strategic, others economic, and others precautionary. Combined, they represent a shift in global financial behavior. This does not mean an immediate collapse or sudden disappearance of the dollar. Transitions in international systems tend to unfold slowly, then accelerate once perception changes broadly. Each reduction in foreign holdings slightly increases pressure on borrowing costs. Each weaker auction slightly alters expectations. Each incremental yield increase reinforces the narrative that conditions are changing. Many people remain unaware because the process lacks a dramatic single event. Financial transformations often occur quietly until they reach a tipping point. The message being sent by global reserve managers is not panic, but preparation. They are adjusting portfolios for a world where financial influence is more distributed rather than concentrated. Whether this transition unfolds smoothly or disruptively depends on policy decisions, economic growth, and market confidence over time. For individuals, the key takeaway is awareness. Economic systems rarely change overnight, but early signals matter. Decisions made during gradual shifts often matter more than those made during visible crises. The situation continues developing step by step. The pace and impact remain uncertain, but the direction is clearer than before. The world may not be witnessing an immediate breakdown, but it may be observing the slow evolution of the monetary order, a change that, once fully recognized, will appear obvious in hindsight.